In today's post-pandemic, high-inflation era, the world's largest economy is revealing a quieter structural crisis beneath strong GDP and employment headlines. A generation of educated workers trapped by record student debt and rising interest costs. This analysis examines how $1.7 trillion in education loans distort household balance sheets, delay homeownership, and weaken long-term growth by turning future earnings into pre-sold collateral. Using a macro financial lens, the documentary explores how policy, psychology, and compound interest have reshaped the American dream, and why this debt overhang now threatens the foundations of upward mobility itself. The screen opens on a quiet, dimly lit bedroom in the suburbs of Columbus, Ohio. It is 6:30 a.m. A young woman, Sarah, sits at her kitchen table with a laptop. She isn't checking social media or the news. She is logging into a portal. The screen flickers to life, displaying a balance, $20,452.81. For a moment, there is a rush of endorphins. To most people in their late 20s, seeing $20,000 in a bank account feels like a monumental achievement, a safety net, a down payment, a cushion against the world's unpredictability. It represents thousands of hours of labor, missed dinners, and disciplined saving. But as Sarah clicks a different tab, the twist of the modern American economy reveals itself. That $20,000 isn't hers to keep. It is exactly the amount she needs to make a lump sum payment on a debt that originally started at $45,000, but has swollen due to compound interest. In a single click, the balance returns to zero. She is back at square one, not because of a reckless spending spree or a failed business venture, but because she pursued the very thing she was told would guarantee her success, a college degree. This is the central paradox of the American dream. In the 21st century, we are taught that education is the ultimate great equalizer, the surefire path to upward mobility. Yet, for millions of Americans, the cost of entering that path has become a systemic deadlock. The $20,000 milestone, which should be a turning point toward building wealth, instead becomes a ghost money that passes through one's hands only to vanish into the coffers of loan servicers. We see this play out across the nation. A generation of high earners who are functionally broke. They carry the outward markers of success, the degree, the professional job, but their financial reality is one of stagnation. This documentary explores how the shadow of student debt has fundamentally altered the value of the US dollar for the individual. When your first $50,000 of lifetime earnings are pre-allocated to debt, the traditional milestones of adulthood are not just delayed, they are often erased. We are witnessing a quiet crisis where the pursuit of prosperity has created a permanent class of debtors trapped in a cycle where every step forward is met with a calculated pull backward by a system designed to profit from aspiration. To understand the gravity of the student loan crisis, we must look at the sheer scale of the financial machinery involved. As of 2024, the total U.S. student loan debt has surged past $1.74 trillion. This is not just a large number. It is a macroeconomic weight that exceeds total national credit card debt and auto loan debt. Approximately 43 million Americans are currently carrying federal student loans, with an average balance of around $37,000 per borrower. However, these averages hide the more harrowing extremes. Over 2.5 million borrowers owe more than $100,000. This financial spiral is often described as a roller coaster, but it is one where the tracks are heavily tilted downward. The phenomenon of the financial trap begins the moment a student signs their master promissory note. Unlike a mortgage or a car loan, student debt is rarely backed by a physical asset that can be sold to recoup losses. It is debt tied to human capital, an intangible asset that the market fluctuates on daily. Systemic traps are built into the very fabric of the repayment process. Financial institutions and loan servicers employ sophisticated behavioral tracking. As soon as a graduate's income rises, The attacks begin not in the form of physical threats, but through aggressive marketing for consolidation, credit cards, and lifestyle upgrades that compete for the same dollars needed to kill the debt. There is a psychological shift that occurs when a borrower finally sees a five-figure balance in their savings. Behavioral psychology tells us that debt fatigue often sets in, leading to a loosening of discipline. When you have worked so hard to save $10,000 while owing $50,000, the urge to reward oneself with a vacation or a new vehicle is overwhelming because the debt feels insurmountable regardless. This is where the ego overrides logic. We overreact to the presence of liquid cash by spending it, forgetting that the interest on the debt is compounding faster than the interest on our savings. This creates a deadlock, where the borrower remains in a state of perpetual working poverty, earning a high salary but owning nothing. The systemic pressure is reinforced by an advertising industry that sells the graduate lifestyle, encouraging those already in debt to borrow even more to maintain an appearance of success, effectively turning the American dream into a subscription service they can never quite afford to cancel. Breaking free from the student loan shadow requires more than just budgeting. It requires a fundamental shift in how one categorizes money within a hostile financial environment. To navigate this, we must look at a model of financial class division for the individual. In this framework, funds are not just spent or saved. They are assigned to three distinct tiers: the floor, the growth, and the enjoyment classes. The floor represents the survival foundation. This includes the absolute minimum loan payments and essential living expenses. The growth class is the most critical and the most frequently ignored by those in debt. It is the capital used to outpace the interest rate of the debt itself. If a student loan has an interest rate of 6.5%, any money sitting in a standard savings account at 0.5% is actively losing value. Operating principles must be established to protect this foundation. A strict rule approach dictates that surplus funds must be treated as captured soldiers in a war against interest. The strategy involves establishing a protection foundation. Instead of chasing the short-term goal of a zero balance, which can lead to total liquidity depletion, savvy borrowers use a floor model where they maintain a specific cash reserve that never touches the debt, acting as a shield against the unforeseen events that usually send debtors spiraling back to square one. Once the floor is secure, every additional dollar is weaponized. This is where the psychology of choice replaces the psychology of burden. By viewing debt repayment as the purchase of one's own future labor, the borrower shifts from a passive victim of the system to an active manager of a portfolio. We must also address the enjoyment class of money. Many financial advisors suggest total austerity, but this often leads to the aforementioned debt fatigue and eventual reckless spending. A structured, small percentage of income must be allocated to enjoyment to maintain the mental stamina required for a repayment journey that may last decades. This isn't about luxury, it's about psychological sustainability. The goal is to move from a state of financial defense, where you are constantly reacting to bills, to financial offense, where you are strategically deconstructing the debt's power over your life. The impact of these two different approaches, reactive versus proactive, can be seen clearly through a comparison of two hypothetical graduates, Michael and Elena. Both graduated in 2018 with $50,000 in debt at a 6% interest rate, and both earned $60,000 a year. Michael follows the standard path. He pays the minimum, and when he receives a $5,000 year-end bonus, he uses it for a down payment on a new car, believing he earned a break. 5 years later, Michael's debt is barely budged because the majority of his monthly payments went toward interest, not principal. His net worth is deep in the negative, and his car is depreciated. Elena, conversely, applied the floor and growth model. She kept her old car and funneled her bonuses and 20% of her monthly income directly into the principal of her highest interest loan. By 2023, Elena has reduced her principal by half, significantly lowering the amount of interest that accrues each month. The data evidence is stark. while Michael will eventually pay back over $90,000 for his $50,000 loan over 20 years. Elena is on track to pay back only $62,000 and be debt-free in 7 years. Real-world reports from the Federal Reserve Bank of New York highlight this disparity on a macro level. Statistics show that for every $1,000 increase in student loan debt, the probability of homeownership for those in their late 22nd and early 32nd drops by about 1.5 to 2 percentage points. This isn't just a personal failing. It is a statistical reality of how debt suppresses the broader economy. Furthermore, data indicates a significant racial wealth gap in the student loan crisis. Black borrowers, on average, owe $25,000 more in student debt than white borrowers 4 years after graduation. This is often due to the lack of intergenerational wealth to fall back on, meaning that starting at zero is a luxury many do not have. They start at a significant negative. These case studies and statistics prove that student debt is not a neutral financial tool. It is a weight that compounds differently depending on your starting point and your management strategy. The American dream is being redistributed not by merit but by the ability to navigate a complex and often predatory interest-bearing landscape. Investing in oneself through education is increasingly becoming a high-risk gamble where the house, the lending institution, is the only guaranteed winner. As we reach the conclusion of this exploration, we must redefine what money actually represents in the context of the student loan shadow. Money is not merely a medium for acquiring possessions or status symbols. In the modern era, money is the primary tool for buying choice and freedom. Every dollar of student debt represents a minute of your future time that has already been sold to someone else. When we view debt through this lens, the urgency of the crisis becomes personal. The big idea here is that the American dream is currently under a lien. To reclaim it, we must move beyond the individual shame often associated with debt and recognize it as a systemic hurdle that requires both personal discipline and broad policy reform. The value of your degree should not be measured by the salary it commands, but by the net freedom it provides after the cost of the degree is subtracted. The final message is a call to action. Focus on protecting the platform. In a world that encourages you to chase short-term goals, the new tech, the trendy lifestyle, the appearance of wealth, the most radical thing you can do is to prioritize your own financial sovereignty. This means being ruthless with your growth class of funds and defensive of your floor. We must demand transparency from institutions and push for a restructuring of how higher education is financed. But until that day comes, the responsibility falls on the individual to be their own CFO. Do not let the shadow of your loans darken your entire professional life. By understanding the psychology of the trap, the mechanics of interest, and the power of strategic management, you can turn a deadlock into a doorway. The dream is still alive, but it is no longer free. It must be fought for, one calculated payment at a time. Your goal is not just to reach a zero balance, but to reach a point where your choices are no longer dictated by a monthly statement. Freedom is the ultimate asset, and it is the only thing worth more than the paper your degree is printed on.